And now, ladies and gentlemen, our next panel, High Inflation and Possible Recession. To answer the question, how do businesses prepare? Please welcome to the stage our moderator, Managing Partner, Investment Executive, RJFS of Cygnus Asset Management, LLC, Lisa McIntire Shaw. And panel members, Matthew C. McAleer, Cumberland Advisors, Nora Yousif, RBC Wealth Management, Dana Peterson, Chief Economist, Judd Austin, Altabank, and Neil Hullinger, Bank of America.
Good morning. What an honor to be at this beautiful facility with this fabulous high-tech background and backdrop. I hope everybody can hear everybody. We are going to talk about the economy, and I'd like just briefly raise your hands if you believe the United States of America is in a recession. Wow. Okay, this is an optimistic crowd. So what we're going to talk about is high inflation, the possibility of a recession, what to do from a macro standpoint all the way down to a micro standpoint. So I will have a seat. I'll introduce our speakers, and then each person will talk about their specific specialty, and we'll work again from the big picture down to individual investors. So my name is Lisa, and next to me I have Neil Hullinger. He is a financial advisor at Bank of America. I have Dana Peterson, who's the chief economist at the Conference Board. Matt McAleer, who's the chief equity strategist at Cumberland Advisors out of Florida. Nora Yousif, who's a financial advisor at RBC. And then at the very end, we have Judd, who is Judd Austin, who is the Chief Banking Officer at Altabank. So welcome our panel, please. So we'll start with Neil, and my simple question to you is, how did we get here?
Yeah, that's a fun road, right? So first off, thanks for letting me be here today. This is an honor. Look forward to the opportunity. I've been with Merrill Lynch as an advisor here in Utah for 25 years and actually see a lot of friendly faces, and it's fun to see you. I'll kind of recap. I'm not going to tell you anything you don't know about how we got here because you've all lived it as well, but maybe add some anecdotal items. So 2020 comes, the pandemic hits, and the world decides to turn off, right? Our politicians and leaders decide to kind of shut things down. And they learned some lessons from 2008 when economic crises come that they employed, they reutilized, right? They started to stimulate, and we had lots of government spending. And we immediately lowered rates. We had immediately accommodative rates. And of course, we also started quantitative easing, right? The Federal Reserve flooding the system with money. But some things were different, of course, than 08. 08 was a natural recession. 2020 was a self-imposed recession. And it became clear pretty quick we would still be okay. But we still did those same actions. We stimulated, we gave money. I'll give you an anecdotal piece of evidence. Bank of America deals with 1 out of every 2 people in America. And they did a study of pre-pandemic, and they looked at every household that had an average balance in their checkbook of $1,000. So that's someone living paycheck to paycheck, really. At this time a year ago, they relooked at that exact group. That exact group had $7,000. That's a huge difference for someone who's used to living paycheck to paycheck. So they stimulated, they gave money, lots and lots of money. And at the same time, they said, don't do anything. Don't go to the movie, don't go to dinner, heaven forbid, don't get on an airplane, don't go anywhere, don't do anything. Well, America is a service-based economy, and they shut the service off. And they said, go buy goods. Or rather, they gave us a bunch of money, and we said, let's go buy goods, because we can't go do anything fun. So goods became the item, right? We wanted to buy things, but the supply chain was shut off. They literally shut it off, right? Everyone went home. compound that, earlier this year, we know, of course, Russia invaded Ukraine, cut off more supply chains when it comes to energy, grains, different things like that. So we've really gotten to a spot where now we are finally at a point where the Fed, we could argue was very, very late to the party. In December, I think the dot plot, maybe correct me someone if I'm wrong, I think the dot plot showed all year this year raising 25 basis points. We know we've now just had our fourth straight 75 basis point increase, so they were very late. They were still quantitative easing through May. So I would argue they were still pouring fuel on the inflation fire through May. In June, they got serious. In June, we started quantitative tighten. I think the last week in June was the first round, and they started raising and raising and raising. The average mortgage went from 2.7 in January to well over 7 last week. So we've gotten to a point where, because there was so much money and so little to do, and the supply chain still being broken, heaven forbid, as we know, there's still major cities with tens of millions of people in China still not allowed out. Because of that, we just became inflationary, right? That's the natural byproduct. Too much money chasing too few goods. So the Fed now has become very serious. They've started to chokehold some of that movement of cash. M2, money supply, grew by 18% from February of 2020 through December of 2021. The Fed's balance sheet grew from $4 trillion to $9 trillion over that same period or till today, essentially. So today, we're finally seeing some signs. We're finally starting to see maybe some things that are working against inflation. And frankly, that's where Dana's a lot smarter than me, and so I'm gonna let her maybe, or some others, take it. But that's kind of where we're at and how we got here, and we've got some work cut out for us still.
Perfect. Thank you so much, Neil. And Dana, let's talk macro, and now that we know how we got here, tell us a little bit about what you see in the immediate future and maybe the longer term future.
Sure, and Neil really set, Neil, right? Yes. Okay, excellent. Really set the table very well here, and just looking forward, it's going to be, I think inflation is going to be kind of sticky, because one thing that's really driving, well, three things that are really driving inflation right now are food and energy prices and rents. Now, food and energy prices are very much being determined by the war in Ukraine, right? That's external to what the Fed can do. But rents are a reflection of what's going on in the housing market. And our previous panel talked a lot about that in terms of, interest rates were brought down to zero during the pandemic. And that really spurred a lot of demand, especially as people were working remotely or hybrid. And that caused home prices to really surge. Now home prices are starting to slow in terms of their rate of appreciation, but that doesn't show up in rents until many, many months down the line. It could be 6, 12, or even 18 months. And so we're still seeing rents rise and increase in terms of the share of inflation, and also what's, basic, your average customer or households are experiencing. And then also, as Neil mentioned, now that the pandemic is more or less behind us in the US, we're all sitting here without masks and we're feeling fairly comfortable, right? Services prices are rising because there's increased demand for services, but also that demand for services and elevated prices for those things are also a reflection of labor shortages, right? You have entire industries, for example, healthcare, restaurants, hotels, transportation, warehousing, manufacturing, where they don't have enough workers. And so what are businesses doing? They're throwing money at their problem and they're raising wages. But the thing is, somebody has to pay for that. It's you and I, it's households, right? So all these things are driving inflation, and the Fed is responding. We can argue over whether they got in the game too late or not, but the point is now, as Neil said, they're serious. They're probably going to continue to raise rates for several more meetings. We may see the Fed funds rate, which is their policy rate, rise to at least 5% or maybe over that. And then they're going to keep it there for the balance of next year and probably not even think about cutting interest rates until 2024. And even then, that might be gradual because there are a lot of factors that are still driving inflation. right? So with that, with the Fed raising rates very aggressively, we're probably going to have a recession in the U.S. I saw a few hands up. And, for our own forecasts, we're saying maybe that recession's kind of starting now, or, mainly it's going to be in the first half of next year. And that's basically because the Fed is clamping down on activity to address the inflation problem. The good news, we think, if there is any good news in all this, is that we may not see a surge in unemployment, right? Usually when you have recessions, the unemployment rate spikes. But we think maybe the unemployment rate will rise to around 4.5% next year. That's still pretty low. I mean, that means something close to 96% of the population is still working. And that's great. If you are going to have a recession, that most people will still have a job and will have some security. And the big reason is going back to those labor shortages. Many businesses are going to hold on to labor because they found it very difficult to attract workers. And, we know lots of people were quitting, so they were also trying to keep workers. So with all that, only about 16% of CEOs are saying they're going to lay people off. So that means the rest are either going to keep labor fixed or even continue to hire. So that's a good scenario, even with, the bad news of recession.
Thank you, Dana. Thank you. Matt, we talked a little bit about the risk-free rate versus how it affects raising capital. And again, as we move down the scope of how did we get here to where are we now, tell us a little bit about, how's the market changed from the standpoint of risk-free rate of return is very different than it was a year ago.
Sure. It's very different than it has been for a decade, right? Coming out of the great financial crisis, as it's known, we've really been in a extended period of abnormally low rates. I mean, a year ago, 75% of the countries around the world had negative interest rates. That's shocking when you think about it. So capital has been deployed with a risk-free rate of return of 1.5%, 2%, versus, I'm saying, a risk-free rate of return. At a 4.25, and 1-year Treasury today's 4%. I mean, the 2-year Treasury last week hit 4.80. 4.80. So in terms of, we look at clients in two baskets. We have individual clients, and then we have business and corporate clients. And that risk-free rate of return is something that gets discussed every single day. And from the individual side, it changes allocations a little bit. We're not really here to talk about that today. But on the business side, and there's plenty of bankers here, there's probably some private equity folks here, there may be some venture capital folks here. That risk-free rate of return often doesn't get discussed as much, but it's real, and business owners, and I'm a business owner, we're a private company, have to really focus in on the fact that your banks and your maybe multi-banking relationships have options with their capital now that they didn't have. And we're seeing that, and our clients are seeing that. And whether you're a builder in, maybe you're a builder across multifamily, apartments, and industrial. And it's been fairly easy to source capital, fairly easy to expand at a 25% loan-to-value rate. In other words, you have to have 25% equity in the deal. And now we're having clients tell us our banks are looking for 40% equity. They're willing to do a 60% loan-to-value. Reason being, as we all know, maybe some softness in the economy, but also because they can take that capital on their balance sheet and buy 4% treasuries with zero risk. So that risk-free rate of return is a term that we use daily that I don't hear too much in the business news and so forth when it comes to businesses. But banks live by it. Private equity lives by it. The one-off on private equity, which has been a big player in the expansion of our economy. 20 years ago, private equity was niche. VC businesses, the VC business was niche. They were a small allocation to the capital raise for the economy. Today, they've exploded. They've raised money with phone calls. That's going to become more difficult for them because their limited partners now have a risk-free rate of return they're going to compare their private equity investments to. So just to finish up, I think what we have to get used to is understanding that the last decade was probably abnormal in terms of what we're going to see, because both from a monetary and a fiscal policy, that shadow of 2008, 2009, 2010 was tough to get out from. And the government and the Fed had a very difficult time normalizing interest rates. And now they're going to be more normal going forward. Just one last thing, so I can talk forever. One last thing is, I think we also have to put into place where we're at. It's a 388 before. A 388 10-year Treasury, it's okay. We can't compare it to the 50 basis points it was trading at a year ago, where three-quarters of the world was at negative interest rates. If we look at a longer-term cycle of interest rates, if a year from now, 2 years from now, we're able to top out at an inflation rate of 2.5, I don't buy the 2 that the Fed talks about, but 2.5, maybe 3, and the 10 years at a 4, a 4.25, a 4.50. In the long run of looking decade by decade by decade, that's still very reasonable. And the economy should be able to handle that. So I guess I'm taking a little glimmer of what can go right and what are some positives currently.
Thank you. And we do want that glimmer of hope. So as we go from kind of the risk-free rate of return, which I think is very important for all of us to remember because it is very different. Cash is no longer trash. Whether you're a business or a municipality, a nonprofit, or an individual, cash is no longer trash. And there are other options. The last 10 years, there was no other option than investing in the equity markets. And today there are. There are lots of other options, as you well point out. Now, Nora, you work with individual clients. So tell the group a little bit about the strategy that you're implementing for your individual high net worth clients.
So I'm not going to sit here and depress you talking more and more about this recession. I would actually rather challenge you to reframe your thinking about recessions and inflation as doom and gloom, but think of it as opportunity. And what do I mean by opportunity? Well, 2 areas. One, Matt started to get into talking about rates. Now, when we're talking about rates, if you compare this to where we were a year ago, we're in a whole different ballgame. This is a government-manufactured recession. And the beauty here is we have a bit of a roadmap where they're raising rates to pump the brakes on the economy to stomp out inflation. And then once inflation is under control, maybe back down to 3%, I agree, not 2%. Once it's back down, they're going to lower rates back down again so we can have a thriving economy again. So that means we have a limited window of opportunity to lock in these higher rates for longer. So for T-bills, almost 4% for 1 year. If you have money in the bank, put it to work. Even if you're a business owner with cash reserves, put that money to work, especially if it's not a C Corp and doesn't get taxed twice. If it's an S Corp, LLC, partnership, or your own checking account, put that money to work, especially with inflation. Otherwise, you're losing or over 7% with that money just sitting in cash. CDs for 1 year are almost 5%. Investment grade corporate bonds for 1 year, you can get almost 6%. Can you hear the excitement in my voice? You should be equally excited about this opportunity for yourself. Now, on the equity side of things, that's fixed income. The more fixed income you have overall in your individual portfolios, the more conservative. The more equities, the stock market stuff, the more aggressive. So on the equity side of things, the key to being a great investor is being a contrarian and doing the opposite of what your emotions are telling you. So if you're afraid with the recession, as the market is right now, it's the best time to buy in and lock in a really great discount, okay? NASDAQ, tech companies are down over 27%. I don't look at that and get scared. I look at that and say, ooh, that's a great discount that I want to get for my clients and myself, okay? So when it comes to equities, also keep in mind, you also want to diversify. And I know you know what diversification means, not too many eggs in one basket. We all get the basic premise. But very few people do it correctly. I had a couple that came in and the husband said, oh yeah, we're diversified. We got 5 funds, Nora. And look under the hood. All 5 funds are all invested in the same stuff. That, of course, was underperforming for the past couple of years, Murphy's Law. So you want to be properly diversified in at least sectors like large cap, so S&P 500, largest 500 companies out there, mid-sized companies, small, international real estate at the very least. Okay, so you're diversified, and that way your winners outweigh your losers, and you get more consistent, predictable returns over time, less of the roller coaster. And that whole premise is called modern portfolio theory. Every MIT class I took in finance mentioned this man's name, Harry Markowitz, who won a Nobel Prize for modern portfolio theory. It's the closest thing to the holy grail we have, where you can take less risk and get better returns through diversifying correctly, and then rebalancing. So you buy low, sell high over time. And when you're properly diversified, especially now, coming out of recessions, you can actually bounce back out of recessions faster than if you're not diversified. So just another reason, especially now, to make sure you're properly diversified. What else can I tell you? Okay, also cost, something to pay attention to. Just like in your businesses, you want to keep your overhead low, same thing with your investments. And there are usually different layers of costs and fees. A client recently came in and they were paying a certain amount and we cut it in half down to 1%. They didn't really blink that their total cost went from 2% to 1%, but then when I did out the dollar signs on what their savings are over 20 years, it came out to about $400,000 of savings. So pay attention to the cost. Next, also I want to point out, this is the great resignation. People are switching jobs left and right. It's still a strong labor market. People will lose their jobs as this further pain sets in and this recession rears its head even more. And people are also contemplating retirement, especially business owners. They've had a rough go. Talk about COVID, what a challenge. And so I'm working with a lot of people and they're just trying to figure out, if I have this much saved, can I not only change jobs but retire, or can I sell my business? And I can't get as great of a valuation because, the market is what it is. Do I need to continue waiting until maybe next year or 2024 to ultimately sell my business and get a higher valuation? Does that make sense for me? To that I say, do the numbers out, know where you stand, know exactly where you stand. I don't like rules of thumbs of how much you need to have saved. No. I like to get really customized, know exactly where you stand, so that way in the greater context of the economy and you hear the scary headlines, you yourself can be calm, you can be rest assured, and thereby focus better on your business and make better business decisions. Lastly, different buckets you should have set up. Great to put this in place and be prepared because what follows recessions is extraordinary growth. It has every single time. General downswings during bear markets is 31%. General upswing following recessions during bull markets is 155%. Holy cow. So the good news is recessions do not last long and there's great growth that follows them. So I want you to be prepared and have the foundation and buckets set up for yourself. Really great tax savings buckets to have are IRAs, individual retirement accounts, very basic. You can set that up for yourself and a spouse, even if they aren't working, as long as one of you are. And you can put away $6,500 a year. That's a start. Next up is SIMPLES and SEPs. For SEPs, especially if you're a business owner, you can put away in 2023 up to $66,000 a year. And then in defined benefit plans, you can put away as much as $265,000 for 2023. Talk about a glorified retirement account, way better than 401ks. And if you put, let's say, 300 grand into retirement in 1 year, that's $100,000 tax savings that stays in your pocket, okay? And so I can talk a lot more about tax considerations, also considerations is if you have children in college, what to do, but I'll say that you can come up to me later and we can talk if you're interested in either of those topics. I wore a red blazer for a reason.
Thank you, Nora. It's very interesting thinking about the different buckets and individuals and what they can do. And I think the takeaway from what you just said is this is the season to prune and shear and prepare. Things are at a discount. It's a good time to do those things to prepare because everything's cyclical. So Judd Austin at Altabank. So let's talk a little bit about business. You know, this is the Utah Business Economic Summit. So what will be the impact of businesses on the higher interest rate environment? And how should businesses prepare for that?
No, I'm happy to address that. Altabank, we deal with everything from micro businesses, sole proprietorships, up to mid-market businesses. And the bottom line is that the high interest rates are going to impact every business in some way. And there's 3 areas I think you really need to understand with your business and how they're impacted. Number 1 is the cash flow. Number 2 is the impact on liquidity. And number 3 is on capital. I was recently talking with a customer who manages a carpet company, a flooring company, and he kind of outlined some of the challenges that they've had over the last year and built up to the couple years. And so they hadn't had any real supplies. They were just kind of just in time getting it out, as we've all experienced. And so they really worked to build an inventory of goods. And so now they have a warehouse they're able to sell, and now the housing market is slowing. And so their demand is down a little bit, and now they're going to have to go in and sell this at now those same goods are coming in at a less price. And the people they sell to, of course, want the smaller price. So they're looking at a large write-down on that, all while the interest costs are going to put some heavy pressure on the carrying costs of the flooring. And so I think that's representative of where we're going to see some challenges in the economy. But the good news is we're in a great business environment here, and our companies in Utah are coming out from the pandemic really strong. They're good liquidity, there's capital, they've managed cash flow. The bankruptcies through the last couple of years are down. Some of that is fueled by the liquidity provided by the government. But overall, we're seeing businesses really able to handle the challenges that we have ahead with the high interest. The bad news is we don't know when the interest rate hikes will stop. The Fed seems to have one tool in their toolkit, and that's raising interest rates, and when you only have a hammer in your toolbox, everything starts to look like a nail. And so the other thing that we really need to focus on as we look at what the impact is on business is you need to look at how you've borrowed money and determine if that's the best use of your capital. We just had a client that has equipment on order. It's been on order for 6 months, and they got ready to do the loan and came in and said, hey, my cash is better put to use here. And so re-examining where that's deployed. The other part of that is looking at what the challenges in that interest rate environment has. It may not be so much that we're at 7% interest. If you look at interest rates between 1990 and 2008, the cumulative average interest rate is 6.98%, and today the Wall Street prime rate is at 7%. So it may not be so much the level of rates we're at, but how quickly we got there. Like showing up to the gym on January 2nd and throwing 245 on the bar is kind of what it feels like for our businesses. So one of the challenges to have on your radar and something banks are really looking closely at is what does the increased rate do to your ability to service that debt? If it was 3.25% last year and that rate's been adjusting all year, going forward you could have double the interest expense, and what does that do? And are you still able to bear that interest cost going forward? Do you need to look at other opportunities to finance your business or how you're taking care of your expenses? So from a bank perspective, I guarantee all of your bankers are looking at what loans are going to have challenges with debt service coverage at the higher rate. One other thing that I would mention is I think it's a great opportunity as we prepare for a recession. Some maybe are feeling the pain of it now, and some will feel it later. But there's really three things I think you can do proactively to help with the cash flow, the liquidity, and the capital of your business. One is stress test your business for what those impacts are going to be on your business. How does an increase in interest rate impact you? It could be you're getting squeezed from both sides because your customers have less buying power, and so your revenue could decrease and your expenses could go up. And so look and see what that is, and then contingency plan ahead so that you know what to do, and coordinate with your trusted advisors, with your accountants, your attorneys, and your bankers so you have a plan for what that will look like. The second thing is optimize your business and use those results to dial in. Maybe you have an unprofitable line of business. Maybe you're in a market that you shouldn't be in, or you have a store that's unprofitable. Dial in where you need to have productivity gains. It may even be that you could restructure, so instead of having 3 decision makers, you could have 2 decision makers and shift a body somewhere to handle more high value product lines. And then finally, Nora alluded to, even on the business side, there's opportunity. Plan for the opportunity and see that you're positioned to be able to capitalize on what opportunities exist to be able to expand in the market. Make this a positive thing. We'll all participate in a recession, but we'll come out looking differently. So look for those opportunities that you might have. Maybe that's going into a new market. Maybe that's another product line. Maybe that's acquiring another business that's a competitor, because if you're not looking for those opportunities, maybe someone else is looking you at as an opportunity. So I think if we look at those proactively, how that cash flow is impacted, how the liquidity is impacted, and how the capital is, that's really the 3 things that get us through a recession. They're the buffers that help us get through tough times.
I think that's such a great point that you said all of us are going to feel the recession, but we're all going to come out a little bit differently. And it's how we prepare right now that kind of measures where we're going to be when we come out of it. So I think that's a very, very good point to make. And we've always used the adage that you need to prepare for war in times of peace. So whether we are currently in a recession or about to enter a recession, we still have time to prepare from a business standpoint. And I think you make a great point about stress testing. And maybe that goes for all of us in our own personal portfolios as well. Just, hey, what if? And that's an excellent exercise for all of us to do when we think when we think of our own financial balance sheet, maybe as a business rather than just our checkbook and goods and services that we can buy. So we've heard from everybody where we are, how we got here, different aspects of where we can go from here. And the one thing that I talked to the panel about as we prepared for today was I asked them to be thinking about what is the tipping point? How are we going to know that the recession is over? How are we going to know when to kind of relax our shoulders and kind of change our stance? And we only have a few minutes left, but I would like each person in turn to give me their thoughts on quickly what is the tipping point? What should we all be aware of? When are we going to hit that point of inflection or the red zone?
Yeah, thank you. So I agree with Nora. I'm wildly optimistic that when we come out of this, there is a very nice bull market ahead of us, bull market for jobs and businesses and the economy in general. For our clients, we're trying to take advantage of that and position all sorts of those things. I think one of the things on the front end that is a tipping point is just our Fed's commentary, right? While they are majorly hawkish, more hawkish comments came out this morning. We're not there yet, right? At some point, the Fed themselves have said the 3-month and the 2-year Treasury is something they don't want to invert, which I think became at parallel like 2 weeks ago. That 2-year Treasury is something to keep your eye on. When that 2-year Treasury starts to come down meaningfully or stay down, stabilize down, I think that's a big deal. At the end of the recession, to Dana's point, which is probably, mid next year, I don't know, I think you have to see earnings not only stabilize finally, but earnings begin to climb again. And I think that's a sign, frankly, when the 2 years starts to come down on the front end, I think the opportunity is there to start buying. When eventually on the other end of that, we start to see kind of that secondary notice where earnings have stabilized, that's probably tells us the recession's maybe found its way out.
Super. So the 2-year Treasury and earnings.
I think what's really going to be important is what CEOs think. So at the conference board, we actually canvass CEOs of big multinational companies within the Fortune 500. And they were calling for a recession back in May, right? That was like kind of the first signal where they said there's going to be a recession because the Fed's raising rates very aggressively to wrestle inflation to the ground. So I think when CEOs say, you know what, we think the Fed's done, and we think that the pain is behind us, we can start, ramping up hiring again to address the labor shortages, which are going to come roaring back because you have millions of baby boomers retiring. I think that's going to be a key forward-looking indicator for when it's over, when CEOs themselves and businesses themselves are saying, look, we've made it through, and better times are coming.
So your tipping point is watch the CEOs, see what companies are doing, kind of shut out some of the noise and watch what CEOs are doing. And of course, your organization, as you said, canvasses them. Matt, what do you think the tipping point is?
I don't really have a tipping point. What I would say is time. Business cycles have not been outlawed. Again, just to get back to the last decade, which maybe have given us a little bit of a distorted view, but there's a lag in what the Fed's trying to do, and we live in a society today where we have Fed governors being interviewed every day. For some of the old folks like me out there, that this is all new. 25 years ago, Fed governors would speak a couple times a month, so there was. Even though the Fed only raised rates first time in January, by March, people were saying, hey, it's not working. I'm not an economist, but most economists seem to believe that their models say there's a drag of 8 months to 16 months on interest rate hikes. Let's see where those hikes get. Let's see where it slows down the economy. Try to stay away from, I'm just taking from our trading position day to day. Try to stay away from extreme views and be flexible. Would be a couple of thoughts I have there. When I was first trading, in 1990, the head trader on the desk, and mine was just behind, had a Post-it note on one of his screens that said, "Money always returns to its rightful owner." And that doesn't mean money goes to money or anything of that nature. But what it does mean is money tends to return to people that make reasonable decisions. And the 0 and 1% interest rates have caused distortions in valuations. I mean, everyone probably read and saw about the FTX. There would be no FTX on the, that's a crypto trading platform if rates hadn't been near zero for the last decade. But money chased extremes, and those extremes just have to come in. So I would say time has to work a little bit.
So your thought is give it time, be patient.
Yes, don't take the first bite of the apple. Great ideas about looking for opportunities. right? Because opportunities haven't been available. They've been so expensive.
Wait for your pitch.
You know, maybe not the first bite at the apple, but things will come.
Thank you. Nora?
This is great because we all have very different answers. Okay, so I say two things that I'm looking at as a tipping point, and it's a great question, Lisa. One is to be or not to be 0.75% hike in December. The Fed is going to make another rate hike. It will be very interesting. They've done 4 75 basis points raises. It will be really interesting to see what they do in December because they're going to have some information coming in. We had another inflation report, more employment numbers, and we'll get an idea about holiday spending, which, by the way, the U.S. consumer makes up 70% of the GDP. So that will be really interesting. And oddly, bad news is good news. So if earnings are bad, if there's more of those target earnings, that's good news because it means the medicine is working. The Fed's lever that they're pulling to raise rates is working. So we'll have a better idea where we're ultimately going if they don't raise rates another 75 basis points and they lower it. That, for me, will be a aha relaxation point. Secondly, the stock market itself is an indicator. Because, again, it's made up of people who make decisions and are emotional. So that gives you a gauge of where people and sentiment is. Markets actually recover 6 months before recessions end. Okay? And governments tend to not call recessions until we're in our way out of one. So I'll leave you with one quote to just simmer on for today. And it's one of my favorite quotes that says, bull markets are born in pessimism, they rise in skepticism, and they die in euphoria.
Thank you. Thank you, Nora. Judd?
I agree with what kind of Matt's thinking is here. I think we have natural business cycles, and we get used to this creation and destruction, and that's been thrown out of whack with the pandemic and the liquidity that was put into the market to support the economy. And so we would have had some natural destruction during that time. If you look back at business bankruptcies through that 2020, 2021 period, we did not see business failures like we usually do. And so with the recession pending, I think for me, and granted this is coming from a banker, but I think you need to keep an eye on the trend in credit losses at the banks. And when you see credit losses increase and then level off and then decrease, I think that's a sign that we're headed out of the recession. That will be a clear sign we've headed out of the recession. There will be a lot of signs like consumer demand and unemployment changing that will indicate where we're at. But we don't know what normal is anymore. We were in a budgeting meeting and an officer said, I'm not sure how to budget for next year. I don't know what normal is anymore. I think that is the new normal, is we don't understand what normal is. And so I think we need to go back to looking at what do normal business cycles look like, and look for us coming out of some businesses failing and then coming back out of that strong.
Thank you. Thank you all very, very much for your time and attention. I encourage you, our panel will be available to ask questions and talk about specific items that you might want each one of them individually to address. And again, it's been a privilege to be here. I appreciate the opportunity to moderate this esteemed panel, and thank you.